This shows the basic brittleness of the US banking system and also that of the large banks in Europe as well. And this is the fear factor which is reflected in the 20% decline in the bank, the KBW index in US. 20% decline. I mean, I cannot imagine in India if the bank nifty were to decline by 20%, what sort of an impact it would have on the country, on the stock market, on the trust factor, and on the sentiment. But we had the situation in US 20% decline, which I thought was.
Yeah, and it's not, I mean, we've talked about SVB, but it's not just SVB.
Yes,
There's Signature Bank, which has also gone into receivership, and Silvergate, which has also collapsed. An interesting point to note over here. SVB, Silvergate, and Signature Bank, all three of them were the only three banks in the US that acted as on-ramps to the crypto world, which is effectively they were willing to process payments and put them in the accounts of crypto exchanges and companies so that their customers could buy cryptocurrency. Like SVB, Signature, and Silvergate all had an internal network as well to offer crypto-backed loans to their customers. One of Silvergate's biggest clients was, I believe, FTX, and it seems almost obvious that the banks that were most exposed to this whole crypto mess have collapsed. It's not a coincidence at all as far as I'm concerned.
Yeah, but one of the real effect of all this is what? Why banks are so important. And if your banking sector is weak, what it means is that they cannot fund the economy, they cannot fund the businesses. And that's where the problem starts, and that's where the panic starts, and which is why you see not just the banks, but the entire market, US, and then the contagion spread to other markets as well. That's when the kind of correction or the decline starts, because if banks are weak in an economy, then I think that economy is poised for recession, that economy is poised for many problems. And I think that's what is getting reflected over here. And most importantly, I think for the Indian markets, what happened again over here is we saw the massive effect of a risk off trade. You discussed this thing risk on, risk off, and let's just take a minute to explain what this risk off and risk on is to the investor.
So risk off, from what I understand, is FIIs are basically pulling their money out of emerging markets.
Absolutely, yeah.
So how does that work? I mean, what precipitates that kind of outflow? Because on the face of it, the fundamentals are strong. Why would you pull money out of a stronger economy into a weaker economy, at least from the outsider's perspective?
Very difficult question to answer, and I've been scratching my head on this one for a long time, but maybe I'm biased towards India. But somebody sitting in US, some investor, he may feel that he's better off in US government securities or in some absolutely sovereign guaranteed funds rather than investing in India, because there is a correlation of the currency factor over here. So whenever there's a risk of trade, whenever there's turmoil in the market, the dollar strengthens and all currencies, including the Indian rupee, tends to depreciate. So if you're holding Indian assets, even if the asset price remains stable, you're looking at a mark-to-market loss because of the currency depreciation. So there are many linkages over here, but instead of getting too deep into it, let's just say that whenever there is a crisis, many or large, in the global markets, in US, FIIs sell. And one very important characteristic of the FI selling is that they are the price makers. They then want to exit in a few minutes, in a few hours, and not try and sell in a systematic, slow manner. They just want to get out of it carte blanche, finished. And that kind of a selling cannot be absorbed by a single buyer. And especially the buying, if it's going to come from the Indian investors, Indian investors are generally the price takers. So when you talk to a mutual fund manager or a dealer, they always want to put the bids lower and lower and then buy. Whereas when the FI wants to sell, he would put a market order, he would try and hit sell as much as he can, and that's what causes the price decline. So the risk of trade is extremely dangerous, and it can overextend itself and take markets to levels which maybe fundamentally you may feel that they're extremely cheap.